that's still the case. It's still a challenging fundraising environment. It's loosening up, I think, a little bit given the macro we're starting to talk about.
With regards to sectors and industries, what's of particular interest for you guys at the moment? Welcome back to the Raw Selection Private Equity Podcast. Joining us today on the podcast is Drew Schardt, Vice Chairman at Hamilton Lane and Global Head of Investment Strategy. It is particularly rare that we have any significantly large AUM private equity firms represented on the podcast. So I want to thank Hamilton Lane for allowing Drew to come on and share everything he has. This is a real high-level overview of the state of play of private equity from Hamilton Lane and Drew perspective, but also their perception of what is in store for the remaining part of 2024. Let's dive in. Drew, if you can give us a brief insight into you, please.
Sure, absolutely. I'm Drew Schardt. I'm the Vice Chairman and Head of Investment Strategy at Hamilton Lane, also lead the firm's direct equity investment platform here. Been here 17 years and have done lots of different things along the way. And so although it's a cliche where people say no 2 days are the same with all those titles, that's certainly been the case for me. And in my experience, have been involved on the investment committee level, the executive committee level. So both, steering the direction of our firm and people strategically in terms of how we're investing, the strategy areas, the areas of focus, but also at the corporate level of where the firm is headed, and have really enjoyed both of those two things, again, over the past 16 or 17 years, given the evolution of our global platform today. On a personal level, before Hamilton Lane had a more, I guess, quote, traditional path, started in investment banking, worked for a couple private equity firms, private credit firms before joining HL. And before that, grew up in upstate New York, Syracuse, New York, to be specific, and am married and have two wonderful kids at home.
Thank you for that insight. So what is one mistake that you see private equity firms or portfolio companies making, and what would you suggest to correct them?
Yeah, I think at the sort of general partner investor level, where we look at, listen, I wish everything could be all roses and everything goes well all the time. It doesn't. I think where we've seen, more or less success when things don't quite go according to plan is really around the sort of speed at which managers make changes, particularly to the management teams, the operators. I don't think we've ever heard a general partner say, man, I wish I'd waited longer to make that change if they did end up salvaging or fixing a situation. And so I think being sort of clear, swift on those changes when they need to be made, but it's a delicate thing because it's almost like a ballroom dance with a partner where you need to have a good sort of symbiotic relationship, follow each other's steps, but someone often needs to take the lead. And I think where we've seen some missteps is when people have waited too long to make required or necessary changes to fix a troubled situation.
My mantra on that is usually if you talk about it once, it's usually a problem. And if it's brought up in a formal setting, it needs a change. But my recommendation is if you're talking about something formally twice, then a change needs to happen. What's your kind of process around whether or not you're just talking about something that you'll hope will go away versus talking about something you need to take action on?
Yeah, and listen, I think I wish there was like a blueprint for if this, then that, and there's never a perfect setup, and it depends on so many other factors. And I think it's also complicated, Alex, as you point out, by the fact that our industry, our asset class, is a long-dated asset class. So you also don't want to just be bouncing around at every little whim of a sniff of a problem or a challenge. And so to us, a big part of it is just transparency in the data and the reporting. And I think this is where I tell you the industry in general has come a long way, where you're getting better data, better information in real time, the technology and the systems. And this is back to your question of, well, who's done those types of things or fixed problems well? Usually it's the information advantages that you have that you can apply to helping make those decisions and making sure that when you are collaborating with a management team or looking at an asset and the performance, you're being informed by real data in real time. And so for us, that's a huge part of our process, not just the conversations we're having, but the actual data and analytics behind that. And as an asset class, I think that's where, the future is. As private assets, you can't always get that information so readily available. And the best general partners, the best firms are the ones that have been forward thinking on how they're setting up, collecting the data. That a big part of that, as I said, is technology that you put around that and those platforms. And that's where we think the best decisions come from, analytically informed in these private companies, privately held asset sphere.
You've written that private equity has exhibited what you referred as a faster snapback in performance compared to the more fundamental global downturns of the dot-com era and the great financial crisis. Talk to us kind of why you think that this time has been different.
Yeah, and I guess anytime I hear someone say this time it should be different, you should probably run for the hills because they're probably wrong. So maybe I'm a bit of a hypocrite in saying it that way. But I think, again, the evolution of the private market space is one part of it. And I'll go back to the general partner side. I look at the vintage years before, for example, the GFC, and start with leverage levels. Your traditional buyout deals, you were seeing leverage levels get to 65, 70, 75% loan to values. So a lot of financial engineering with those types of assets. And so when things went wrong, you were sort of doomed with that level of leverage, lower interest coverage coming out of the gate. And so what I would say is context over the last most of the last 15 plus years, where things were up and to the right in terms of purchase price multiples going up, lots of liquidity, low interest rate, the loan to values have still stayed for private market buyout firms right in the 50 to 55% range. So meaningfully lower than the last sort of downturns, more fundamental downturns in terms of that leverage level, is giving businesses a bit more financial resiliency and wherewithal when things are more volatile, when they are choppier. So I think you're seeing that resiliency come through. You didn't see some massive uptick in default rates, for example, like many predicted when interest rates started to move upward. So I'd say that's probably a lesson learned from, the general partner, the lead sort of investor side. On the other side of it, the LP side, I would just say that the asset class is more accepted today in how it works. It's not as much of a black box as it was in the dot-com GFC, where, man, these returns look good on paper. I hope it works out, but these GPs are a little secretive. How does it work? Now, if you look at the first decade of the century, all of the performance is really realized. And so it's not a question of, can it perform? Can it outperform? How does it do in downturns? So I think having a level of comfort in how the general partners are going to create value, and that's a whole nother topic of the multiple levers in a value creation plan. I think that's another positive way. There needs to be more than one way to win or create value. That's something that general partners haven't been putting their eggs all in one value creation basket, if you will. And all of those things, I think, have bode well in the more recent sort of history of performance. But the last thing I'd say, and I caveat it, is, it's not always all roses. And candidly, this is back to did we really have a recession? No, we haven't had a technical recession. Certain parts of Europe did technically last year. But this may be one of those very unique times in history where the central bankers and the Fed in particular get it right. And, we've sort of been circling the airport. We've been asking hard landing, soft landing. We've just been sort of treading water. And the data is starting to point to that this soft landing scenario, or threading that needle, which is really hard to do, it looks like that could indeed be the case. And so I'd say another big part of it is you haven't had a technical recession, particularly in North America. And so that's also, just to be fair, a part of what's happening here as well, because a lot of the business fundamentals are still relatively very strong comparative to those other periods.
So interesting with this, because that was going to be my caveat point regarding probably haven't seen the significant downturn, and maybe that was we saw that obviously in COVID, obviously a force point, but we haven't seen that so much this time round. What private equity firms have seen is a significant amount of obviously deal flow reduction, fundraising difficulties. But with regards to, from your perspective, are you starting to see the green shoots now coming through from fundraising being a bit more active and also deal flow increasing? We feel that we're starting to see that. I mean, we predominantly executive search for North America. So I don't know, actually, ironically, I'm based in the UK, but I don't know what's going on in Europe. But are you beginning to see that, or is that just our take on rose-tinted glasses?
No, I think it's okay to have those, because I think that's the right take. And I think, as it usually does, and as you mentioned, the piece, the macro piece we put out, it does start with interest rate and interest rate policy. And as we read the room, whether it's investors in terms of limited partners, whether it's the deal makers, it just feels like, compared to 12 or 18 months ago, more, or I guess the best way to say it, there's more clarity or less uncertainty around global monetary policy, meaning, rates have likely stabilized. They may come down. It's up for debate how quickly they come down. They're already starting to come down in parts of Europe, as you know, faster, but there's been a decoupling with North America and the US. But I think regardless of those developed market pictures, there's a general comfort that the worst of runaway inflation, the data is coming out today here in the US, it looks kind of like it's back below the 3% level for the first time in a long time. So what that means, I think, is rate policy and investors' expectation are that it won't go up materially here in sort of Europe throughout the medium term. And that, to your point on the green shoots, that's when deal making starts to happen again. You can price your cost of capital. It's a lot easier to buy. Think of buying a house, or it's the same thing buying a company. If your cost of capital, your cost of debt is 5 or 6%, that's going to impact how much you can pay. But if it's 10%, that's also going to impact how much you can pay. But if it's 10% and you don't know it's going to go to 12 or 13, that's where you create a gap in where the deal making starts to break down, both in terms of the price you pay, the buyer versus seller expectations, and a long-winded way of saying that is all starting to dissipate. The gap between buyers and seller, there are green shoots. The pipeline on our direct equity platform and with many of our partners is as robust as it's ever been. Exit volumes is up materially year over year from where it was back. So for the investors, liquidity is starting to come back in. Whether we like it or not, whether it's superficial, investors like getting cash back. They like having money coming back into the coffers. They feel better about their portfolios, their positions. If they have a little bit more flexibility, you're not hearing denominator effect. You're not hearing recession as much as you did 12 or 18 months ago. And so, again, I think that this shows you the tide is shifting. It doesn't mean there's not challenges, that there won't be volatility. There's some unknowables on the horizon and how they play out still that could really change all of that. But for us and what we're seeing in the investor tone and sentiment, deal making is picking up. We expect a very busy back half of the year in particular for deals and for exit activity in the private equity sphere, just based on that backlog and pipeline. So again, I think that creates a very different feeling, sentiment, tone for the go-forward outlook for most investors compared to where we were a year ago.
Yeah, the markets love boring and love, we know what's going to happen. Everything's going to, which obviously you've still got your major election. We've had ours, but you've still got your major election to play out. And then we'll see hopefully more boring, fingers crossed. And the markets continue to recover and private equity continue to see more of those green shoots. And I hope as well for a strong end to the year that will benefit us all.
Yeah, listen, I think the geopolitical, you just touched on it. I think it was a year, by the end of this year, the statistic I saw was over 50% of the world's population will have voted in some election. You had your big moment. We're having ours coming up, and every day the picture changes. And I think those are the sort of pieces on the horizon that could really disrupt if they go a way that is not anticipated or expected. And what I'd say here in the U.S. is the one thing, based on on the last several elections, the last several major presidential, like the pollsters have really been quite wrong leading into elections in many cases. And so you never are going to have full clarity. But, again, our asset class, the part of it that we deal with is we deal with things on longer term horizons, expecting at least some level of volatility. But that magnitude is certainly going to largely be dependent on some of those geopolitical pieces that are all still moving around quite meaningfully.
Well, it keeps us on our toes and allows somebody to be to predict everything well and tell you when it's all going to go wrong, and they can be Mystic Neg for a day. So you mentioned a little bit about you mentioned a lot about the recovery, and as we're seeing, obviously, those green shoots. Early this year, the media was incredibly focused on the growing buyer-seller pricing gap. What do you expect of that gap as the markets start to stabilize?
Yeah, it's already starting to come in. It's starting to abate. I think, again, back to the interest rate policy piece plays a huge factor in that. There's also, history would tell you when there is a buyer-seller gap, the buyer's usually the first one to blink. And I think what has happened over the last probably 6 months or so, and it depends on the industry sector, we've seen purchase price multiples, value multiples on new acquisitions really stabilize. And in many industries, call it your boring consumer, industrial, even some healthcare businesses, probably come in a turn or two in terms of enterprise value, EBITDA multiples. And so that's allowing, with more comfort on your debt financing for the buyer, it's allowing deals to start to happen in volumes and pipelines to pick up. And so, as I said, I'd expect it to be a pretty strong finish to the back half of 2024 in terms of deals getting done. And then last point on that is back to the data and analytics. You obviously could have challenges or unforeseen, geopolitical circumstances. But if you look purely quarter by quarter at data on activity levels, on exit volumes, on distributions, the back half of the year, statistically speaking, always tends to be busier. If you look at the last 20 years than the first half of the year, you're building your pipeline, you're negotiating deals through a year. Oftentimes, investors have budgets to get deals completed within a certain vintage year. And so I'd expect in Q4 in particular is the busiest on a percentage basis. So again, not that that's a perfect crystal ball for what's going to happen, but to us, as I said in the beginning, we like to look at the data at least as one point to consider when you're thinking about predicting the future in a very unpredictable world.
Sorry to interrupt. Just a quick mention of a long-standing partnership with Schardt. As you will probably know, the private equity scene is constantly evolving, and deal flow is moving now to proprietary and data-driven processes. Schardt provides you with the data and information of over 7 million private companies. So if you're looking to improve your proprietary deal flow and improve the data access, then reach out to Schardt today. Now back to the podcast.
We've spoken about the inflation rate reducing. We've seen Europe make the first moves. Hopefully you guys as the predominant global currency will start to follow, and that'll push everybody else as well. You mentioned the geopolitical and obviously the what will be look like Trump versus Harris at the polls soon. What else do you see that may kind of throw out that progress of stabilization of the buyer expectation versus seller expectation?
Yeah, I think you certainly keep it in the geopolitical, certainly a conflict, whether that's the Middle East, some of the things happening, in the Asia Pacific region. And so, again, those are hard to forecast, handicap, or predict, but could have major implications. I think for us, we also worry a little bit with what is likely to be a pivot now following what you're doing there in Europe, in the US, in interest rate policy is, what no one's really talking about, but it's on the horizon. And I'd put it at a lower probability, but, the potential for stagflation over, the next, again, probably tied to a major geopolitical event, but where growth slows more than anticipated, particularly in the US, and inflation, for a number of reasons, starts to really pick back up. And then you're in a really tough spot. And again, I think that would not bode as well for sort of the near to medium term outlook. And so I think those are the things, if you ask me what's sort of keeping me up at night, aside from my two hyperactive dogs, that those are the types of things that, we think about, but you can't control that. What you can control is the capital structures you put in place to manage and be resilient and have the wherewithal to manage through volatile, choppier times or slowing growth environment, as well as just the asset selection. I think, asset selection in deal picking or a deal picker's market is more pronounced in terms of its importance than it probably has been at any other time in the last 15 years. We're again back to low interest rates, lots of liquidity. It was a rising tide, for most strategy areas, public, private, various industries. I think now you're going to see the geographies you pick, the sizes of the assets and companies you focus on are going to matter. The industries certainly matter a lot more today in terms of the outcomes in 3 to 5 years than maybe they did where the returns were clustered in that low interest rate up into the right environment that was pretty much the most of the 15 years previously.
Interesting. I've not heard stagflation mentioned for probably over 6 months. So it's interesting you bring that to the forefront just to keep us all up at night, as well as you said, if your dogs are behaving.
It was lower probability, but it's still, again, something I don't think you want to go think about where things are going, obviously. And, usually sometimes people tend to huddle or hurt around certain sentiment, whether it's interest rate policy, other things. And I think we get a little bit concerned when, if you look at, like, I think it's within the piece, like the mentions of recessions, or when people aren't getting as nervous, that's maybe when you want to pivot and think through defensiveness and how you want to balance your investment approach to help sort of manage if you are concerned with stagflation or any other sort of more negative or downside oriented scenario.
And again, we're not going to predict the crash or the stagflation event, but do you think that that's predominantly centered around or as we put it politely, a geopolitical event of some sort? Do you think that's mainly centers around that? Obviously Russia-Ukraine conflict kind of had that conversation around stagflation, mainly because Europe's food basket and everything else from that perspective, whereas we were all going downhill with regards to, or interest rates were increasing and cost of living was going up. Do you think that's mainly centered around geopolitical, or do you think there's other factors that could drive that as well?
I absolutely agree. I'd add, keeping a close eye on Chinese, Taiwan, Philippine sort of, relations is a big one. And I think, tied to all of that, and not just the first order sort of conflict issue, is you've also had the benefit for 50 plus years going backwards until more recently of globalization being the trend and more efficiency in shared supply chains and systems. And so that is certainly reversed course pretty dramatically over the last 2 to 3 years, which increases costs, causes companies and assets to have to focus on dual sourcing of components or inputs and other things, the labor markets becoming more decoupled globally. That all ties to your politics. And again, here in the US, I'll use that example, Donald Trump would have very different policies relating to U.S. international trade relations than I think someone like Harris or what Biden has done. And so again, those are all the things that are hard to handicap, and they're always changing day to day, it seems like, in terms of what the likely outcomes are. But those are meaningful pivots. If you think of back to my first comment on the globalization trend, those all had huge impacts on costs globally, as well as the operating sort of network and setup and efficiency, buying an asset, what you need to think about versus that asset 5 or 10 years ago in a very different globally linked world and system. And so that's probably one of the bigger, no matter what the thesis or asset or geography is from our investment committee packages, that's really where we're going to try to understand, again, things that are beyond our control, but we need to have a plan around how we're going to navigate that sort of uncertainty.
So this year's been plagued with the world's going to hell in a handbasket. We're all okay. We're all fine. It's all going to be good. And the framing of this conversation has been very much, it's not been as hard a landing, and whoever's going to take credit for that, and then let them do so. But you wrote a white paper that kind of pointed to increased activity and liquidity. You mentioned here that you're seeing H2 to be very positive, or at least Q4, and seeing that build up. What are you thinking about? What is Hamilton Lane thinking about that kind of what's happening in H2? What we're going to see from a end of Q3 into Q4 of this year?
Yeah, again, I think pick up in deal activity levels. I think we haven't talked about it. A lot of pent up demand. This is a difference, I'd say. Probably general partners have learned. We look oftentimes at their pace of deployment relative to the dry powder that they've had, and fundraising. Not a surprise. I heard one of your earlier guests in a previous podcast talk about his 1, 2, and 3 pain points were fundraising and capital formation. That's still the case. It's still a challenging fundraising environment. It's loosening up, I think, a little bit given the macro we're starting to talk about. But the general partners have been more thoughtful about sort of not only spacing out or being sort of disciplined in their deployment, but also bringing in partners to help them complete transactions and extend that dry powder further. And so I think, as investors, while you expect to have an uptick in liquidity, you expect to have an uptick in deployment, the focal areas by industry and what you think about are going to be really, really important in the back half of 2024, as we've talked about.
Warren Buffett's a big advocate for talking about seasonality and referring that to business. If we say that we're possibly coming out of what was a warmer winter than we could have had, and we move into spring, what's Hamilton Lane doing to maximize the spring and the summer? If you're predicting we're going into that, what are you guys kind of thinking? It might be a podcast itself, probably a 10-hour conversation, but what are some of the things that you guys start to think about as, well, we probably need to put this in, we probably need to think about that?
Yeah, absolutely. I think that's a great question and well said with the spring and summer, because I think if we do indeed get this, threading the needle in a soft landing scenario, this is where I think investors, they like to deal in certainties and finite situations of it is a recession or the cycle has ended. And I think what happens in this soft landing scenario is the cycle doesn't stop or start. It sort of extends the current cycle that we're in for another several years, and then you kind of can readjust or reacclimate. It almost is sort of like what happened in the mid-90s when interest rate policy pivoted here in the U.S., et cetera. And so with that kind of context in front of you where, it's not the time to go all in or all out on one strategy. This is one of the benefits of private markets in general. There's more ways to invest, which means top-down portfolio construction is as important as it's ever been, not just because, there's more than just like buyout, venture, distress, and that's it. That was the early 2000s sort of picture for a private market investor. Today, look at just private credit, how that part in the landscape has involved. Things like secondaries, private infrastructure, and real estate. Those give different risk, return, liquidity, duration characteristics. And so what I would tell you is we spend a lot of time talking and working with our clients on what is our top-down portfolio philosophy? How should we blend those different choices, therefore different risk, return, liquidity, duration expectations together to build a portfolio that we think is going to have a reasonably predictable path of outcomes over the next 2 to 3 years. So while you're not going all in or out on any one strategy, a balanced view towards risk mitigating strategies. And for us, that's been private credit, infrastructure, as well as secondaries. But it's also a pretty interesting time for the boring old middle market buyout. I think you have to be layering in equity upsides, and we love that part of the spectrum. Back to it, you have to pick your spots in the company in the size spectrum. There's just a lot of ways to win in these small and mid-sized businesses, and there's just a lot more opportunities. There's nearly 10 times as many, if you think of companies that are sort of below $2 billion in enterprise value or lower, there's 10 times as many companies in the buyout side. So I'm not talking about venture or startup or mom and pop. but just in the buyout realm. And so target rich environment, less picked over, and usually multiple paths to win. That last one's really what you got to think about, because as we just spent a large part of this podcast talking about, there is going to be uncertainty. There's going to be things you can't predict. And if your whole value creation plan is tied to one lever or one organic growth sort of path, and you don't have inorganic growth, there isn't some element of efficiency or cost cutting, maybe there's a strategic element or channel expansion or dual sourcing of supply. Like, you have to have a plan that can pivot and be a little bit nimble. And that candidly is what we love about that middle market part of the spectrum. It's usually more optionality usually exists in how you're going to go from point A to point B in what is likely to be a very choppy macro for the next 2 to 3 years.
I'm a big believer that the world, any industry, there's plenty of business out there, there's plenty of opportunities, and everything can operate. So I'm going to ask something here of you, Drew, with regards to sharing a little bit probably about what Hamilton Lane's thinking about. With regards to sectors and industries, what's of particular interest for you guys at the moment, and what are the tailwinds that make these appealing, if you're happy to share it?
Yeah, of course. Happy to share. And I'll share generally and talk to a little bit of like what we've been thinking about doing. And so I think you certainly like industries and sectors where you have a playbook or that you've invested before. It gives you a little bit of familiarity. It also gives you some synergy by having an incumbent book. So while, the generic answer from most GPs is we like defensive sectors and healthcare or industrials. We like generic sectors like healthcare and industrials, but within healthcare, again, I'll use one, the clinical research, sort of pharma development space, CRO organizations. They're increasing efficiency and effectiveness of new drug development. We've done over a dozen deals in that sector over the past 10 years, so really do have that playbook. There's a lot of resiliency in the characteristics of those businesses, predictable revenue visibility depending on the stage and the trials and what area of focus you have, high margins, good free cash flow. Those dynamics are things, obviously, you'd like in a buyout or a levered asset. We talked a lot about changes in globalization trends. And so global supply chain and logistics businesses are areas similar. We've done a lot, and there's sort of first, second, third order type businesses where, there's the shipping vessels and transportation oriented aspects. Then there are things like, repair, maintenance, componentry around fleets and optimization of that. Third-party light logistics organizations that are essentially the coordination, administration, servicing, and all the sort of, non-asset intensive elements of that. And then there's sort of like third order of like automation of warehouses and supply chain lines. So we've invested in a few chip-oriented businesses that focus on precision automation that is utilized in warehouses and in supply chain manufacturing. Those have been a really unique way to play that changing what has gone from a global tailwind to a headwind. But for those businesses that offer better efficiency, better optimization, as well as, the opportunity to source in different ways than what you had 2, 3, or 5 years ago, those have been good plays for us within our portfolios of sectors we like and how we might play some of those more secular themes that we've already discussed.
That's interesting. If your prediction is right, then that'll work quite well for us because our portfolio team play predominantly in industrial services, and healthcare. So I will be delighted if you are correct with regards to that, and we see a ton of deal flow coming from a search perspective. So I hope that your predictions there are right, Drew.
Yeah, we'll see. The crystal ball, hopefully it is working. But just like anything, I think having a diverse portfolio back to the top down matters too. I mean, that's the other part. We started with what's changed or is different in the industry today. We talked about the data, the analytics. And I think this used to be an asset class, as you well know, Alex, where people would talk about this great deal or the cocktail party, the sexy asset that we just bought, that it does this. And I just did that. So, of course, I'm saying what I did. But I think for us, that is important. It always will be bottom-up underwriting and approach and value creation planning. But because the asset class does have more available options for more types of investors, that does make portfolio construction philosophy more paramount than it's ever been. And I think that's one thing where, we have a dedicated team internally that, just like they might want, our clients might want to talk to the credit team or the equity team or the secondary group. They want to talk to the portfolio. We affectionately refer to them as like the quant jockeys who come from math, science, data analytics backgrounds. And they are thinking, how do we blend all these building blocks that we now have access to? How do we blend them together to manage the near term, the medium term, long term? How should I think about horizon modeling, cash going in, cash coming back? So I'd say the investors in this space are becoming more sophisticated. They are evolving, and portfolio philosophy is a huge, huge part of that. And it wasn't nearly as prevalent in any discussions I'm having, today, it wasn't that way 15, 10 years ago, like it is now. So I think it's a good positive sign that our asset class, candidly, is looking like what you would see in the listed public side. Everything there does start with top-down strategy, portfolio construction, and it's less about the cocktail party anecdote, as I said. And so that's where we're going as an asset class and an industry, and that's probably a really good thing for investors.
Not only am I the host of the Private Equity Podcast, but I'm also the founder and managing partner of Raw Selection. Raw Selection is a private equity specialist executive search firm with two divisions, one that focuses on portfolio, C-suite executive hires, and one that focuses on private equity direct hires via back office and investment deal professionals, operating across Europe and North America. A unique offering of our service is that we offer a full money-back guarantee on all upfront deposits. We typically take around $10,000 as an upfront deposit to commence a search process. The remainder is then on completion, but that upfront deposit is completely refundable. If you're not happy with our service, we'll refund that upfront deposit, no questions asked.
So private equity is getting a lot more noise. It's becoming it's moving out of its traditional hidden asset. Nobody knows anything about it unless you're inside of it. And people like Tony Robbins have written a book. His latest book on money and stuff talks predominantly of moving away from his traditional of put it in, Warren Buffett approach, put it in S&P 500 and leave it and become a millionaire type approach. And his recent one was something called retail investors for private equity. How does Hamilton Lane kind of view this as an opportunity, and what's your kind of sense around this new investment option, and obviously the potential flow of further capital into private equity?
Yeah, private equity is probably, maybe rightfully so, always had a lot of noise, some good, some bad. And I think a lot of it, no one's going to play a violin for the poor, lowly general partners and investors like us and some of our partners. But I do think we haven't done ourselves any favors historically when it comes to being transparent, when it comes to not just sort of keeping everything in here and saying, I'm creating great returns, so it doesn't matter, the manner in which the sausage is made, so to speak. That has changed dramatically. I think because investors and managers have recognized, if I am not just a good steward of the capital, but if I provide transparency, if I provide education back to, it's very clear the patterns of performance and outperformance and relative performance, let's share not just what those data points are, but how is that being created? What are we doing? What is different about this asset class than the listed side? And guess what? When the world and the private equity world started to embrace better transparency, more education for newer investors, by the way, it's not all just institutions, endowments, pension plans. You're now seeing a world, and I think this is a big driver of it, where more individual, high net worth, ultra high net worth investors are just the tip of the sort of spear in terms of the potential opportunity that exists in the more individual investment options and structures available for, not just institutions, but for individuals. That is changing. But what those investors demand is what they get in their public portfolios. A lot of detail, a lot of data. And so I think in a world of haves and have-nots, the haves have been the ones who have embraced that sea change of transparency and education. And it's only going to continue, I think, to continue to go more towards that versus sort of maybe the legacy model of don't ask me, just be happy that I'm creating these great returns and performance. And that is opening up new avenues, new channels of investors that can benefit from better returns potentially versus what they're getting in more traditional listed public asset classes.
Yeah, it's interesting the nature of the closed nature of it. I remember when we first looked at setting this podcast up, what will be now 2 or 3 years ago, and the feedback we got when we said to people, do you think this is a good idea? And they're all like, I think it's a great idea, but nobody will talk to you. And we are, 80, 90 episodes in of all private equity professionals all coming and sharing their story and getting it. We still get some that approach us and then they're like, compliance has told us we can't talk to you. And I'm like, okay, fine. But certainly it's starting to open the doors and allow people to come in and obviously, hopefully invest more capital. That will bring its challenges as more and more money floods into the market. It gives more and more opportunities for the mistakes to happen, let's say. But there's no industry's perfect. And, every industry's got its ups. Industry's got its down. But I'm a big believer that 80% of it's good, 20% of it's bad. And it's just avoiding the 20%.
Yeah, listen, I think you got to understand the risks and how to think and structure around that from an investment standpoint. But I think the sort of risk we could control around investors just aren't comfortable with the asset class is starting to dissipate. And that hopefully wakes up the industry to say, hey, it probably is a good thing to share more of this data, to utilize technology, by the way, which is the other big part of how we're using, the data to be more transparent and educate. Technology platforms that not just sort of allow us to select investments, but to share information, reporting, access on those investments to a broader group of potential investors. And so that should be a momentum builder I'd expect for the industry going forward.
We talked a lot about the world of private equity and gone through a fair few topics there, Drew, so I thank you for that. But what are your influences? What do you read? What do you watch? What do you listen to that you would recommend that others listening to this podcast check out?
Yeah, that's a good question. I guess, I'm kind of a nerd. And so unfortunately, or fortunately, my reading tends to be books on like business culture, behavioral economics, sort of strategy. Huge Malcolm Gladwell fan. Reading the book right now, Radical Candor by Schardt. I also focus a lot on just daily, what am I looking at reading? And so there's all the sort of normal outlooks or sort of outlets rather, the CNBC, the Wall Street Journal, the FT. But one of the more recent ones I really started to dig into, I heard an interview with a 4-star general, former NATO commander, and he was explaining how, in addition to all the cool classified stuff he got, that one of the best sources of information he found was The Economist. And so what I regret, and we didn't talk about this, but like, I wish I had found or subscribed with, it's not cheap, unfortunately, but it's worth it. I've been sort of a subscriber to that publication. I'm not affiliated with The Economist, just in case any of your listeners are thinking, why is he plugging The Economist? It's just such a great global perspective on a wide range of topics, finance, economics, to culture, to different regions. And so I'm really glad I finally found that and should have found it earlier. And then watching, huge fan of sports, so a lot of sports. Obviously, the Olympics were awesome. I think Paris set a new bar. LA's got to follow that, which is going to be tough. And then on the fiction side, there's a show here in the U.S. called The Bear. It's about a guy who has a restaurant, and it's pretty interesting play on interpersonal connections and human interactions. And so have loved watching that one.
Appreciate the insight. Yeah, Kim Scott's Radical Candor. We've got that as one of our values in the business. It's something we practice on a regular basis because it's not easy. It's like literally education does not prepare you to speak to people and tell them what's good about what they did, or equally what's poor about what they did, and do it in a radically candid way. So it's a book I absolutely love and highly recommend.
That 100%. If you can see behind me, there's this little blue placard here, and it's got our 5 core values, and one of them is integrity, candor, and collaboration. And her book really does focus on the candor and the collaboration piece of it, and it's really fantastic. So wholeheartedly agree with you on that.
So if anybody wishes to reach out, Drew, how best do they get in touch with you?
Yeah, I think LinkedIn is, I guess, the new norm for that. So Drew Schardt, Schardt, on LinkedIn, and happy to connect with folks that would like to.
Perfect. Yeah, LinkedIn, the new business card, and Microsoft taking over there. Well, thank you very much, Drew, for coming across. I would like to say we don't get too many. We get people reaching out, and we get people that we've invited into the podcast at some of the larger cap firms and larger firms, but we haven't had any actually come on due to compliance reasons. So I just want to thank you guys for coming on. Thanks for giving us an insight into your take on private equity and everything that's going on. Incredibly valuable, and giving us that insight into a slightly different world within private equity. So I do want to thank you for coming on to the podcast.
No, thank you for having us, Alex. It's been a pleasure, and love the podcast and think it's great, what it's doing. So thank you for having us.
Perfect. And thank you very much for all of our listeners for tuning in yet again to the Private Equity Podcast. Till the next time, keep smashing it, and thank you very much for listening.